Hey there, I hope you're doing well during these difficult times. In today's lesson, we're going to try to cover hedging, one of the most difficult topics for HSC Business Studies students. Before we get into the content, I would just like to go over where hedging is in terms of the overall syllabus. Well, if you're astute, you'd probably notice that hedging is part of the global financial management section under the finance topic. And for your own benefit, I would say try to link hedging to exchange rates and derivatives when you're making your own notes, because those three sub dot points are intrinsically linked. By the end of today's lesson, you should be able to answer three questions. So, what is hedging? Why do we use a hedging strategy? And how do we use a hedging strategy to benefit a business? So, let's begin with the first question. What is hedging? Put simply, hedging just refers to all actions taken by a business to minimize risks associated with a financial transaction or a financial position held. For example, let's say you're a mining business selling some minerals overseas. So that's the transaction, right? Undertaking such a transaction would generally expose you to several risks, including but not limited to operating risks, foreign exchange risks, and even economic risks. As a business, you don't want to be exposed to these risks unnecessarily, right? So you want to make a hedge, or what we call building a hedge or building a fence around the transaction so that the business is no longer exposed to these risks. That's essentially what hedging refers to, building a fence around the transaction so that the business is no longer exposed to these risks. In particular, for business studies, we are focusing on foreign exchange risks. If you're interested, feel free to go and take a look at what each of these other risks mean, but they are not covered in the business studies syllabus. Before we move on to discussing why we use a hedging strategy, however, I would like to just go over the mechanics of exchange rates. An exchange rate can either move up or down. So if an exchange rate moves up, that's what we call an appreciation. In other words, one currency's increases in value relative to another, and then if you have a depreciation, that's what we call one currency decreasing in value relative to another currency. An appreciation would be, for example, if 1-to-1 AUD to USD exchange rate increases to 1 AUD equals 2 United States dollars. And a depreciation would be, for example, if the exchange rate was 1 AUD to 1 USD, and then suddenly the exchange rate changed to 1 AUD equals half a United States dollar. Just note that when the Australian dollar appreciates, let's say against the United States dollar, on the other hand, we would say the United States dollar has also depreciated. So when there's an exchange rate fluctuation, there's usually a simultaneous appreciation for one currency and a simultaneous depreciation for another currency. Okay, cool. So now you understand how exchange rates work. So moving on to our second question. Why do we use a hedging strategy? To answer this question, we should best use an example. So let's say you're an Australian business selling to a customer based in the United States, and you're also borrowing from an Australian bank. Maybe you're borrowing $100, to pay off the labor that you're using to transform inputs that you need to sell to your US-based customer. So you, as an Australian business, sell some goods and services to the US-based customer, and in return, you get 100 United States dollars from the US customer. Just note that you're getting USD because you're selling to the US, so you're not getting AUD. That means you, as the Australian business, will need to convert the USD that you have obtained from a US customer into Australian dollars before you can pay off your bank. Because you are required to exchange that USD into AUD, you suffer from what is called transaction exposure. So the exposure is simply the fact that you have to engage in a foreign exchange transaction every time you sell to the customer. And that is risky. Because what happens if, let's say now, the exchange rate has suddenly changed from 1 USD equals 1 AUD into 1 USD equals half an Australian dollar? Well, now, instead of being able to convert 100 United States dollars into 100 Australian dollars, you can only convert that into 50 Australian dollars. Essentially, that means the Australian business, you as the Australian business, will generate 100 United States dollars in revenues, but when that revenue is converted into Australian dollar terms, i.e. denominated in the Australian dollar, you only have 50 Australian dollars in terms of revenue. So you suffer from lower profitability. But you also suffer from lower liquidity because you owe the bank 100 Australian dollars and you can't pay off that loan with 50 AUD. So to sum up, why do we hedge? Well, hedging basically prevents this risk altogether by essentially eliminating the transaction exposure. So the benefits of hedging, or why we hedge, is because it ensures a business is able to remain liquid, and it also ensures that a business is able to maximize its profitability. Now you know why we use a hedging strategy. So we can move on to the third question, which is how do we use a hedging strategy to make sure a business benefits? Well, there are three types of hedging strategies that we can use for the purposes of HSC Business Studies. And those three hedging strategies are forward exchange contracts, options, and currency swaps. So let's start off with forward exchange contracts. What is a forward exchange contract? Well, in short, it's an agreement to exchange a predetermined volume of currency for another at an agreed rate at a future point in time between two parties. And usually a forward exchange contract is terminated or settled within one financial year. So, for example, if Qantas agrees to exchange 10 million Australian dollars for United States dollars with the Commonwealth Bank at the agreed exchange rate of 0.7198 AUD per USD on the 30th of June 2021, then we would say Qantas has engaged into a forward exchange contract with Commonwealth Bank to exchange Australian dollars for United States dollars. The effect of this is that it essentially allows Qantas to lock in the exchange rate to eliminate the impact of possibly lower liquidity and profitability associated with exchange rate risks. So one advantage of forward exchange contracts is that clearly it provides businesses with more certainty when they conduct international financial transactions. The second advantage of forward exchange contracts is that unlike an option, which is another hedging strategy that we will get into in a second, forward exchange contracts do not carry a premium cost. I would note, however, that forward exchange contracts do still carry a brokerage cost, but they are negligible compared to the premium that you have to pay when you purchase an option. Now, there are still some disadvantages with a forward exchange contract. One is that you cannot benefit from a positive exchange rate movement. So think back to the example we had earlier, where the Australian business was selling to the United States and it was generating revenues in the United States dollar, where it had to convert that USD revenue into Australian dollars in order to pay off its debt. So in that case, if, for example, the United States dollar had actually appreciated against the Australian dollar instead of depreciating, then the Australian business would be able to generate more revenue in terms of the Australian dollar, and so actually increase its profit in the Australian dollar due to that exchange rate movement. But if that Australian business, for example, had decided to engage into a forward exchange contract before that appreciation of the USD, then the Australian business would not be able to benefit from that exchange rate movement. The second disadvantage is that with a forward exchange contract, you have a contractual obligation that is enforceable in a court of law. And this can cause liquidity issues. So if, for example, Qantas is not able to come up with 10 million Australian dollars on the settlement date of 30th of June 2021, then it is liable in court. Okay, so that's how forward exchange contracts essentially work. And so now we'll move on to options. What's an option? Well, it's an agreement for one party to have the choice but not the obligation to exchange a predetermined volume of currency for another at an agreed rate, what we call the strike price, at or within a future point in time with another party. And just like forward exchange contracts, options are usually settled at most within one financial year. For example, if Qantas chooses to buy a choice to exchange 10 million Australian dollars for United States dollars with the Commonwealth Bank at an agreed rate exchange rate of 0.7198 AUD per USD at or before 30th of June 2021, then we would say Qantas has bought the option to exchange a certain amount of currencies with the Commonwealth Bank. The effect of this is that it also locks in the exchange rate to eliminate the impact of possibly lower liquidity and profitability associated with the exchange rate risks, just like a forward exchange contract. But it also gives a business like Qantas the ability to benefit from positive forex market changes. Why is that? Well, if Qantas, let's say, had the option to exchange 10 million Australian dollars, on the settlement date, then it can choose not to exchange at the fixed exchange rate of 0.7198 AUD per USD if, like, let's say, the exchange rate was more favorable for Qantas, right? So with options, you have more choice and you also have more flexibility. There's also more flexibility in that a business can exchange the currencies at any time before the expiry date of the option and when the business has cash. So note how with options, you can exchange one currency for another at or within a future point in time with another party at an agreed rate. Whereas with a forward exchange contract, you can only exchange on the settlement date, so at a particular point in time. So with options, you have that flexibility. If you're a business, for example, and let's say you bought a option that lasts one financial year, and let's say 6 months into the option contract, the business has enough cash and wants to settle the option, then the business can choose to do so because it has enough cash. So with options, you have the flexibility of using the option at any given time you want before the expiry date on the option occurs. The third advantage of options is that also you have no obligation to exchange. So you don't have the liquidity risk that we have with a forward exchange contract. Fourthly, with options, you can also create complex strategies that can suit your business's needs, like the costless collar or covered calls. And there's a bunch more that you can search up on like Investopedia, but I won't be covering them here because this isn't covered as part of the business studies syllabus. There are some disadvantages to options, however. First of all, as I mentioned previously, is the premium cost, right? If you buy an option compared to a forward exchange contract, you would have to pay a premium for the ability to choose whether or not to exchange one currency for another. So the premium arises from the fact that you have a choice rather than an obligation. The other disadvantage is that because options are complex to execute, you may need to hire a financial advisor to help you carry out this option strategy, and that can be quite expensive. Just look at how much financial advisors are paid on Google and you'll know. So that brings us to currency swaps, which is our final method of hedging that we will be covering today. Currency swaps are arguably the most complicated form of hedging strategy that you'll find in the business studies syllabus. However, I think a really easy way to understand this is to simply think of a currency swap like this. It's basically where two businesses agree to exchange currencies now and then agree to swap those currencies back later at an agreed rate, i.e. using a forward exchange contract. And then so they basically exchange now and then swap the currencies back later. You may be wondering, why would you want to do this? Why would you want to exchange currencies now and swap back later at an agreed rate? Well, let's just dive into an example to kind of see how this works. Let's pretend, once again, you're an Australian business, but this time you want to expand into the United States. One way you can do this is by having a currency swap. Now, you'll see in a second why this is important. Okay, so we have the Australian business here, and then we also have, let's say, another United States business. Let's say this US business also wants to expand into Australia. So basically, you as the Australian business wants to expand into the United States, and so does the United States business wants to expand into Australia. As an Australian business, if you want to do business in the US, you need to have United States dollars. Okay, so if you want to establish a business in the United States, you've got to have United States dollars. Simple, right? But the Australian business might want to borrow money from a US bank instead of domestically. I don't know, maybe the US bank has lower interest rates, right? And also maybe because if the Australian business borrows from its domestic bank, it will have to exchange at an unfavorable exchange rate in order to get that money into United States dollars. So there's an incentive for the Australian business to essentially borrow from the United States bank. And similarly, this is true for the United States business that wants to expand into Australia. Okay, so the Australian business now wants to borrow from the US bank, and the US business now wants to borrow from an Australian bank. Okay, if you're with me so far, that's great. Here comes the most important part. How can the Australian business borrow from the United States bank when the Australian business has no established reputation within the US, right? The US bank is going to be thinking the Australian business is a very high risk investment because they don't know about the Australian business's reputation. And so if you look at the financial processes, right, when we think about risk, usually high risk is associated with high return. So the US bank, because it sees the Australian business as having no established credit reputation within the United States, it's going to require the Australian business to provide it with a higher return, i.e. having the Australian business to pay a higher interest rate. But the US bank would not treat the US business in a similar way as the Australian business because the US business has a credit reputation with the US bank. So the US business is able to borrow from the United States bank at a lower interest rate. So what's essentially going on here is that the US business can borrow at a lower interest rate than the Australian business if the Australian business wants to borrow from the US bank. Okay. So now comes the crucial part about currency swaps. A currency swap essentially allows the Australian business and the United States business to each benefit from each other's credit reputations that they have established with their own banks. So for example, if let's say the US business was to borrow from the US bank now, the US business would be able to get a loan at a very low interest rate. And similarly so for the Australian bank. If the Australian business wants to borrow from the Australian bank, then it will be able to get an AUD loan at a low interest rate. Going back to what we said earlier, the Australian business wants to expand to the US, right? And so the Australian business would want to have USD, and it will want to borrow from the US bank. And similarly so, the US business will want to borrow from an Australian bank and borrow AUD from the Australian bank. Now, what happens here is that the Australian businesses borrow from the Australian bank, and then the US businesses borrow from the US bank. Now, what both businesses can do is essentially swap the money that they have borrowed from their own respective banks, and then have a forward exchange contract to kind of lock in the exchange rate at which they will swap back their respective currencies in the future. This way, the Australian business is able to obtain USD from the US bank at a low interest rate, and the US business is able to obtain an AUD loan from an Australian bank at a low interest rate. Effectively, the Australian business and the US business have both benefited from their own respective credit reputations that they have established with their own respective banks. Then the next step of a currency contract is quite straightforward. The Australian business essentially pays the interest payments on the USD loan, and then the US business, because it's operating in Australia, right, will be able to generate Australian dollar revenue, which is necessary to pay off the interest payments on the Australian bank loan. So what's happening here is that both businesses borrow from their own banks and then give each other the money that they want, and then the Australian business pays off the US dollar loan, and then the US business pays off the Australian dollar loan. Now, the final stage of a currency swap is where both businesses essentially swap back the principal amount that they have borrowed from each other. So, if you recall from earlier, the Australian business gave the US business some amount of AUD. So now the US business returns that back at the end of the currency swap, and then the Australian business also returns the United States dollars back to the US business. And because we have a forward exchange contract established earlier between the Australian business and the US business, both businesses in different countries are able to swap back those currencies at a certain exchange rate that they already know of. And then the Australian business uses the AUD the USD business gave them to pay off the Australian bank, and vice versa. And I would just like to clarify again, because the exchange rate was fixed in the beginning because of the forward exchange contract, the cost of the final repayment for both parties is fixed. Now, turning to a more verbal coverage of what the currency swap means, let's just go through what the definition of currency swaps are. Effectively, it's an agreement for two parties to exchange their currencies in the spot market with the expectation of exchanging those currencies at an agreed rate at a future date. So if Qantas exchanges 10 million Australian dollars for United States dollars with American Airlines at 0.7198 USD now, and then agrees to exchange the currencies back at the rate of 0.7198 AUD in 3 months' time, then we would say Qantas has engaged into a currency swap. The impact of this is that it allows Qantas to lock in the exchange rate with its transaction with American Airlines and then swap them back later at an agreed rate at a certain date. And this is good. Why? Because it allows Qantas Airlines and American Airlines to each benefit from each other's respective credit reputation. Right? You know, Qantas would have a good reputation with Australian banks. American Airlines would have a good reputation with American banks. So, because Qantas is able to use American Airlines as a proxy to borrow from American banks, Qantas is able to benefit from the lower interest rates that American Airlines would get. And then vice versa for American Airlines who wants to borrow from an Australian bank. Second advantage of currency swaps is that it allows businesses to borrow from countries with low interest rates, right? If Qantas, like let's say, wants to borrow from the US, if like let's say the US has lower interest rates than Australia, then it can do so through a currency swap. And the third advantage is that it provides both parties as part of the currency swap with a lot of certainty. You know, they don't have to suffer the transaction exposure that you would get if they swap back the currencies at the spot exchange rate. Because with a currency swap, you have a forward exchange contract that locks in the exchange rate at which the parties engaged in the currency swap would swap back the currencies at the end of the currency swap. The disadvantages of currency swap are several, and one of the most important ones is what we call counterparty risk. This isn't really covered in your textbook, but I think it's an interesting one to go over. So if you recall earlier, right, the United States business has to provide the AUD that it would swap back with the Australian business at the end of the currency swap. Now, what happens if the United States business doesn't have sufficient money to satisfy the obligation required as part of the forward exchange contract? Well, then the Australian business must then exchange its United States dollars generated in the US as part of its US subsidiary back into Australia at the spot rate to pay off the Australian bank loan it has obtained earlier. I'll explain this in a diagram in a second. And the second disadvantage is that it's also maybe very difficult to find an overseas counterparty, i.e. another party willing to engage in the currency swap, where the currency swap would contain the exact desired amount of currency the business wants to obtain. Okay, so just to clarify what counterparty risk means, let's go back to the example where it's now the end of the currency swap. So the Australian business has to pay the US business the USD. The US business paid the Australian business at the beginning, and then the US business also has to pay the Australian business the AUD. The Australian business has paid the US business earlier. So basically, they swap back the currencies at the end of the term. Now, what happens if the US business becomes insolvent? Right? Let's say because of COVID-19, the factory shut down, they're not able to generate sufficient cash flow in order to obtain the cash needed to execute the forward exchange contract at the end of the currency swap. Well, of course, the Australian business can sue the US business, but in order to obtain a settlement for that lawsuit, the Australian business is going to wait for a long time, right? So what's going to happen in the meantime? Well, the Australian business still owes the Australian bank that AUD loan repayment, right? And it's not going to be receiving that repayment from the US business. So the Australian business will need to come up with this AUD loan repayment on their own. How can the Australian business do this? Well, the most prevalent way is to just basically convert the USD the Australian business was to give the US business back into Australian dollars to pay off the Australian bank. But note, however, because the Australian business doesn't have a forward exchange contract with anyone else to exchange the USD into AUD, it will still suffer from transactional exposure, i.e., the Australian business will have to convert the USD principal it was to pay the US business back into Australian dollars at the current spot rate, rather than the agreed on exchange rate that the Australian business and the US business had agreed on when first engaging into the currency swap. That concludes today's lesson on hedging. And now you should be able to answer these questions. What is hedging? Why do we use a hedging strategy? And how do we use a hedging strategy? Specifically, strategies in relation to financial instrument hedging. I would like to thank you for watching today's lesson. And if you need any extra assistance, I'm more than happy to help you out. I offer private and group lessons and usually answer questions on the HSC Business Studies discussion group, which you can find on Facebook. I'm more than happy to answer any questions you may have. Just feel free to comment them in the comment section down below. And please see the descriptions for more details and resources that may help you out for business studies. Once again, thank you very much for watching. And if you enjoy the content, feel free to like and subscribe so that I can make more of these in the future.